EEM. This is the iShares MSCI Emerging Markets ETF. If you're using Invest USA, this belongs in the emerging markets asset class, and this is probably your riskiest asset class when investing. But it also is the least correlated to the S&P 500, so it's really great for diversifying your investments. EEM was made back in 2003, so we're going to look really far back today when back testing. It has $20 billion in assets under management. It's kind of expensive at 0.72%. Its current yield is 2.22%, and it's going to pay these distributions semi-annually. It's a fairly active fund with over 25 million shares traded each day. You're going to get the price you want with a bid-ask spread of 0.02%. Has a low PE ratio compared to the S&P 500 at 14.75. Has a 10-year beta of 1.02, so it's really not that volatile. And a 10-year Sharpe ratio of 0.38. Looking at the returns, the 1 year is 18.98, 3 years 17.82, 5 years 6.34, 10 years 7.34, and the 15 years 3.36%. So we're going to test out saving $500 monthly. Start from absolute scratch, and we're going to build a portfolio with EEM and put about 17% of our money in it. So, saving over the last 10 years, you were better off just investing in the S&P 500. Basically, all that diversification was just a waste of time, right? You could have just listened to Warren Buffett and buy the S&P 500, except when Warren Buffett loses half his money in a year, he's still a billionaire. When you lose half your money in a year, you're probably not okay. Saving $500 a month for the past 10 years, you had about $15,000 more with the S&P 500. All the other metrics were pretty similar, but where the S&P 500 really shines is the Sharpe ratio. It's pretty far ahead over the last decade. Using Testfolio, we can look back over 22 years and rebalancing a portfolio monthly. There's the same kind of story. You're better off just investing in the S&P 500. Testing just the asset classes in Portfolio Visualizer, you can see back from 1995, the US large cap outperformed until about 2003, and then emerging markets outperformed until about 2015, and we're back to the US large cap outperforming. We kind of knew this from the first backtest. But you just have to ask yourself, is the emerging markets going to outperform from 2030 to 2040? I mean, we don't know, but I'm always going to say finding the highest Sharpe ratios and the least amount of correlation between assets, that's what keeps you out of trouble. That's what Invest USA is trying to do. It's going through quintillions of combinations. And if you really want to get technical, you should probably buy the hedge version of emerging markets funds because US is the reserve currency. So in the long run, that currency is always going to outperform the emerging market. You're going to slowly lose money if you don't hedge that bet.